Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcanan, along with Brianna Valesky, and I have Adam Sarhan on the line. He is founder and CEO of Sarhan Capital. Adam, how you doing this morning?
Excellent. It's a pleasure to be back.
Could you tell us a little bit about your firm, Sarhan Capital? You guys do a couple different things.
Yeah, Sarhan Capital is a boutique investment and advisory firm. We offer three basic services: institutional advisory service, we offer asset management, and then offer research for individuals.
Okay, and we're getting off to a little bit of a rocky start this year. Let's just start with your global macro picture.
Absolutely. Last year, the big takeaway from 2014 is that the QE trade has evolved. What that means is basically Mohamed El-Arian said it, the former PIMCO guy, and he had a great way of eloquently stating what the underlying fundamental backdrop is for global markets. Meaning, for most of the rally from '09 all the way up until 2014, October of 14, during QE, whenever the Fed was printing money, the stock market would soar, and then other markets were kind of in somewhat of a holding period. Initially, they rebounded, but then for the last 3 or 4 years, they were really moving sideways. But stocks would just chug higher, specifically U.S. stocks. Every time QE would end, the S&P would fall and fall hard. When QE1 ended, the S&P fell 17%. QE2 ended, the S&P fell just over 20%. And then when QE3 ended in October of last year, just a few months ago, interestingly enough, the S&P didn't really fall as much as people expected because the QE trade evolved. What that means is that other central banks instantly stepped up and really ramped up their efforts to stimulate the global economy, and that's helped keep the S&P at or near record highs.
And
The
now,
other concurrent factor, sorry,
I was just going to say, I mean, you're talking all about the QE and everything, and now you're kind of getting the reversals, but I'm sure you were going to go into that. Go ahead.
yeah, the next concurrent factor to keep in mind is what's happening with the other markets outside of the equity market or stocks. If you look at currencies and you look at commodities, last year was a massive game changer, a tectonic shift in what we saw since maybe 2010. And for the first time in a long period, we saw currency markets and commodity markets really go nuts. And what I mean by that is that the price of crude oil in about a 6-month span got cut in half. Gasoline, same thing, if not more. So agriculture across the board, outside the softs, but really if you look at the grains, they got hammered. Soybeans, corn, wheat, things of that nature, all falling 40, 50%, 30%, massive declines across the board in some of these commodities. At the same time, you saw the U.S. dollar soar and hit 11-year highs. So the underlying notion, why is the dollar rallying? It's because the Fed's going to be, the belief is that the Fed's going to be the first major central bank to raise rates later this year. So that's going to help the dollar rally. So the market's moving in anticipation that the Fed's going to be the first one out of the gate to begin raising rates. Now, since these commodities are priced in dollars, they're very sensitive to the currency changes. And when you see massive changes in currencies, that typically is not healthy for the global economy. And last year, we saw the yen implode. We saw the euro implode. Just this morning, the euro's at a new, I think it's a 6 or 7 year low. And the Aussie's falling hard, the Canadian's falling, the dollar's falling hard. So there's a lot of big moves going on underneath the surface, even as the S&P 500 sits at new or near new all-time highs.
And let's talk about the oil market. I mean, I know for sure from talking to you, you had been, playing that on the short side, and I can't remember your exact words, but you didn't seem too intent on covering anytime soon. Have you changed that stance, and have you flipped to a long, or are you still trying to ride that short oil position?
No, I would definitely stay short. There's no question. I believe I was in your show. Oil was just over 90, and I was talking about shorting it then, and the thing has just gone straight down. If you look at what we do, a lot of what we do is we trade in now. So what does that mean? We trade on what we see happening, not what we think will happen. So we let the markets be our boss or judge or, guide us, if you will. So in a situation where it's very humbling to say, okay, I'm going to let the market guide me. But doing that allows you to remove your ego and the emotions from the decision-making process, and then it allows you to make objective decisions. So what we do is when we look at the market, we always want to see where capital is flowing. And we believe that capital knows no boundaries. So just like time, how we just had the New Year celebration a few days ago, and you wake up the next morning, it's like, okay, it's another day. If you didn't know that it was New Year's Eve or New Year's Day, there's no way for you to know that it's 2015 versus 2014 or whatever the case may be. So same with markets. When you place a trade, you want to ask yourself, well, irrespective of the calendar, let's say, for example, you see a setup, and it meets your criteria, and it's December 20th. You have a week to go before the end of the year. Would you place that trade if you were, let's say, in March or April of the year? Meaning you're not worried about your year-end results or whatever the case is. If the answer is yes, more likely than not, the right time to place a trade is at that moment. But it's a very difficult thing to do because most of these portfolio managers get paid based on their end of month and end of quarter, also end of year returns. So they don't want to blow it when it comes to either they're having a lackluster year, like last year. I think over 1,000 hedge funds shut down in 2014. It was one of the worst years for hedge funds since before the financial crisis, just because the terrain was so difficult. And that comes into play also in the personal psychology. Like, okay, well, should I really make this trade, not make the trade? Should I go long now because it's gone too far? One of the oldest rules in the book is oversold markets can get a lot more oversold, and overbought markets can get a lot more overbought before they inevitably correct.
Okay, so moving on, seasonality patterns. We had Jeffrey Hirsch on, the author of the Stock Traders Almanac. Is that something you have on your desk? Is that something you follow at all?
I follow it, but not religiously. I'm aware of what they say. I think they do a lot of great work.
Okay.
But to me, the primary determinant of any decision that I make in the market is the price.
Okay. Well, prices have been falling. We're talking about some of the seasonal tendencies, the end of the Santa Claus rally here. Had a weak January last year, but that wasn't actually the barometer for the remainder of the year. What are you keeping an eye on here? In the first couple sessions we're into the second session of the trading year, but in this early week or so, what are you keeping an eye on?
With respect to stocks, January 2015, where we are right now, I think as long as the QE trade remains intact in some way, shape, or form, the market's going higher. So fast forward this time next year, the stock market most likely will be higher. That being said, there are some concerning developments we're seeing underneath the surface. Take a look at October. The S&P 500 trades like a penny stock, and that's not healthy to see volatility pick up after a big move. And then basically what I mean by that is the first 2 weeks of October, the S&P fell 8%. The next few weeks, the S&P soared 14%. That's not normal for the S&P 500 to be down 8% and up 13 or 14% in a few weeks' time. Then you also you basically November was a wash. Then in December, the second week of December, you saw the S&P had the largest two-day decline since 2011, which was in years. And then the very next week, you saw the largest two-day rally since 2011. So that type of increased volatility is typically not a healthy sign after a big move. But the reason why a lot of these quote-unquote professional investors are getting hit this year and hit hard, or they have been over the last few years, is that QE is distorting markets, and there's no question about it. So that's why a lot of the portfolio managers that are professional, whether they're equity long short or CTAs, whatever the case may be, having a really difficult time navigating these markets because typical normal quote-unquote trends or things that should happen are being distorted because of the massive influence from outside the central banks. So that being said, the central banks around the world, including the U.S. Fed, even though they're not printing money right now and with the QE, they made it abundantly clear if the Main Street or Wall Street takes a dive, they'll step up and do QE4. And that central bank put is alive and well. And that's a bullish fundamental backdrop for the equity market, and I think it's going higher. We might go lower. Obviously, it'll be a bumpy ride. But for the most part, as long as that central bank put, and what I mean by that is basically the central banks of the world are going to step up and do whatever they need to do to stimulate both Main Street and Wall Street if either one of those get in trouble. That's a central bank put. It used to be called the Fed put, but it's evolved now to become the central bank put. And as long as that's in there, market participants know that the path of least resistance is higher. Let's put it that way.
Okay, because I had a good question lined up for you there. Then you kind of answered it, but I'm still going to go back to it. You said that the market's going to go higher as long as the QE plan is still in effect. And then you went on to explain that, instead of the Fed put, it's, the world central bank put. So you think that any chance of interest rates going up this year? You think that's just hogwash? That the strength that we're seeing in the economy is all smoke and mirrors. No threat of interest rates going higher. It's just a question that they're not going up at all, and they're going to stay flat. And then anytime we have any kind of weakness in the economy, Fed's just going to turn the spigot on again. Is that your stance?
It depends on how weak, whatever, any type of weakness. I don't think any type of weakness, but any type of material weakness, and the answer is yes. So as far with respect to interest rates, I don't think, even if they do go up a little bit, it's not a concern as long as it's not a wild spike. So we're so low, and we're artificially low, and everybody knows that we're so artificially low. You have to ask yourself from an investing standpoint, what areas of the market benefit from low interest rates? So the easy ones are housing, financial, even some discretionary areas, staples, industrials, things of that nature. Because what happens is it's a lot. It serves as there's two things that are happening: artificially low interest rates, and then insanely low, or really deflation is more of a concern right now because commodity prices are going low, but really low energy prices. And I don't want to say food prices are low because they're not, but they're starting to come down. I feel are a good, healthy thing for the consumer because it serves as an indirect tax on both Main Street and Wall Street. So when you have more money in your pocket, because instead of spending $80 at the tank or $70 or $60 to fill up your car, you're now spending $30 or $40. Every time you do that, multiplied by hundreds of millions of people across this country, you forget the world, billions of people in the world, that just translates to a lot more disposable income. And what most people do with disposable income is they spend. And that becomes a velocity of money where it's like, okay, now it starts to stimulate the economy, and then they spend, that adds more jobs, that creates more money, and the wealth cycle, the whole concept goes and goes. So energy prices coming down to a point are, quote-unquote, healthy, as long as they're not a massive, we don't see crude at $10 a barrel in the next 2 weeks, because that becomes, there's a fine line between energy prices falling and energy prices imploding where it's demand destruction. And
Okay.
what I mean by that, if there's a question there, it's like, okay, how do you determine price? And Economics 101 tells us it's a function of supply and demand. So if supply is steady, which it is, then demand is the other component. So if demand just disappears, that means the global economy, demand is waning, and that's an unhealthy sign for the global economy. That's why these central banks want a little bit of inflation, and they're really worried about deflation.
Okay, and how does gold play in this whole scenario? Not a great year in 2014. Actually, it's heading down, straight down since late 2012. Any room for gold in your portfolio?
Yeah, actually, we made a lot of money in gold over the last few years. Gold's in a bear market. Same with silver. And you got to keep in mind, in 2011, they hit their all-time highs. Since then, they've been falling. Whenever I say bear market, I just simply mean a decline of over 20% or more from a recent high. So you look at gold, you look at silver. Those are the two big metals that we look at, and they're both in bear markets. So keep in mind the path of each of is lower. Now, I do have to say, for gold and silver, they both are trying hard to bottom. Now, in November of last year in 2014, and then again in December, you saw a lot of big up days in gold. And that was almost of a bottoming process, if you will, where you had that shakeout low, and then that 1179 area was more or less support for a year and a half. When the gold prices imploded in 13, which we were short during that time, they fell 100 points in 2 days. And more or less in June of 13, all the way up until late last year, gold moved sideways, and 1180, 1179 was a floor. And then it kind of was trading between 1179, 1180, all the way up to maybe 1400, and then back down again. Last year, it broke below 1179, which is support. But then a few days later, it's back above 1179. And for the last month and a half or 2 months now, it's been more or less trading right near that area. 1180, 1190, goes up to 1200, comes back down again. So it's doing its best to hold on well. But if the dollar continues to rally and more or less a deflationary concern comes into play, I'd have to expect gold and silver to continue falling because typically gold is a hedge against inflation. And right now, the world is more concerned with deflation, not inflation. And therein lies the dilemma for gold bulls right now.
Adam, let's switch over to looking at some specific names here. IBM has been the worst performer in the Dow in the last 2 years. What are your thoughts for someone who's considering that as a long-term investment?
Sure. Typically, what we do, I mean, we have a website for all your listeners. It's findleadingstocks.com. You're free to go there. You can take a 30-day free trial, try the service. We focus on leading stocks, not laggards. So, what do I mean by a leading stock? As objective as possible. Forget the fundamentals. It's a year-to-date performance play. So, we look at the strongest performing stocks because that right there, if you can narrow your focus down to just those leaders and then look for advanced entry points in those leading stocks, our studies and research shows you'll do phenomenally well because by definition, those stocks are going higher. And as long as they're leading, we'll focus on them. If they don't lead, we're out of the way. See you later. And there's no hard feelings type of a thing. So with IBM, it's not on our radar. Now, for bottom fishers and people that want to buy, attractive valuations and things of that nature, that's fine and dandy, but it's not our forte because we prefer to look at strengths. And if you want a valuation play, we like to look at undervalued growth stocks. So what do we mean by that? Look at something like Apple. Apple's PE is below the S&P 500. We've been bullish on that for over a year and have done very, very well in it. That's a great example of if you want that value play, look for the undervalued stocks, but add the growth component because the big quarters of and sales growth and earnings growth, that really means a lot for Wall Street because investors like growth. And when you have a stock like IBM, it's the worst performing Dow for 2 years now. It could bounce, and it will eventually bounce because they've got a very, very strong platform, and they serve a very, very strong market. But they need to innovate the way Apple did 14 years ago when Apple came out and said, okay, we have a game changer. IBM needs another game changer. And until they're able to come out there with a massively successful item or service or product that is going to appeal to the masses, their stock still has some trouble.
And you just mentioned Apple there briefly, and looks like you had some year-end profit taking here, backed off a little bit. For long-term bulls and Apple, is there any reason for concern?
Not right now. I think it's a little premature. You had a massive move in the second, third, and fourth quarter of 14 of the last 3 quarters. So right now, Apple's just trading near an all-time high, and it's backed off maybe 4 or 5 points or even 10 points from an all-time high. It's perfectly normal and it's perfectly healthy. If anything, one of our approaches is buying dips, but not buying dips in the way of everyone else, just arbitrarily just going in there and getting it. What we do is we buy the bounce after the dip. So in uptrends, you have pullbacks. It's perfectly normal. It's healthy. It happens. That's a dip. Now, instead of just going in there and trying to buy a dip, we're going to wait for that dip to run its course, and then when it starts bouncing again, that's when we get in, and those are the advanced entry points. We've got 3 webinars on YouTube on it on our website. You can go to findleadingstocks.com or sarhancapital.com and click on free educational webinars, and you can see them all. And it basically, the approach with Apple is you look at the fundamentals and you say, okay, this past Q4 holiday season, what was the best item or top item to get everybody? If it wasn't number 1 or 2 on people's list, it was definitely in the top 5. And if you look at your product cycle, you're going to renew your iPhones, you're going to renew your iPads, you're going to renew your Macs in some cases. Whatever the case is, Apple's ecosystem is alive and well. Their PE, their valuation still is attractive. It's undervalued. And if you look at just a normal valuation of a stock, forget about some of these guys that are like Amazon or Facebook that have high PEs.
Yeah, right.
If Apple just gets to a normal area, you're talking about another 20, 30, 40% upside in a blink of an eye. So I don't see a reason to be concerned with Apple trading just a few percentage points below its all-time high.
Okay, Adam, thanks for joining us, founder and CEO of Sarhan Capital.